participants. Today we have
Good morning, madam.
Professor Nagaraja, who is a professor in Department of Commerce, University of Mysore. He was my teacher in MBA in 2000. Then he moved on to the Commerce Department. I am fortunate to have him as my teacher during my MBA. Thank you very much, sir.
Thank you.
Let me introduce Nagaraj sir has completed his MCom in 1996, and since then he is teaching in PG Department of Studies in Administration, Business Administration, and Department of Commerce. And he has gone to Dubai and worked there for a long time. And we call him Dubai Nagaraj sir only because of that, because he has a long tenure of experience in working in Dubai, in academic city, knowledge village, Dubai. And he has successfully guided 16 students for PhD, and currently 8 of them are working. And sir has visited various universities in India and as well as abroad, and especially the Gulf countries like UAE, Oman, Bahrain, Iran. Recently, sir has chaired a session on banking and finance in a conference held in USA, which was organized by World Business Research Institute. Today, sir will be addressing you for first 2 sessions on EVA and MVA, a corporate perspective, for the first 2 sessions. Sir, it's over to you, sir.
Okay, thank you, Amulya. Very good morning. So how many are there, Amulya? 18 or 20?
Sir, 38 participants are there. Out of that, 10 are from Tamil Nadu, 1 from Assam, and 1 from Maharashtra, sir, and 26 from Karnataka, sir.
Okay, good. Thank you.
Thank you, sir.
Thank you.
I'll leave, sir. Thank you.
Thank you. So good morning, one and all.
Good morning, sir. Good morning.
Good morning, sir.
Good morning, sir.
Good morning.
Good morning.
Sir.
Very good morning, sir.
Morning, sir.
Good morning, sir.
Yeah, good morning. So,
Morning, sir.
very good morning. So today I would like to speak on a new version of financial analysis, a very important aspect also. It is titled as Economic Value Added and Market Value Added. Much before that, we must understand the need for that and what is the fundamental aspect involved in it. As we know very well, we do a lot of analysis, financial statement analysis. This is one of the yardstick to measure the performance of corporates or the business organizations. We're all comfortable in teaching ratio analysis in the classrooms as a part of the syllabus, as also as a part of curriculum, and we are doing it. It may not be an exaggeration if I say what your teachers were teaching you, or rather what my teachers taught me, same thing I am teaching in the classroom. So same thing might be your experience as well. So those days when you were doing commerce graduation or post-graduation, the things were different. And your students at present whom you are teaching, the scenario is entirely different. Corporate scenario, companies' affairs, and business strategies, tactics, and performance, evaluation. There is a gamut change in the entire perspective of the corporate world. Now, this is a scenario where we witness a lot of dynamism, a lot of global competition. So it is very, very difficult to upgrade those things and fit into the syllabus. As and when it is required, of course, we are supposed to modify, which we are not doing at regular intervals. So therefore, there is a dire need for us, for all the teachers, teaching community, to upgrade our own syllabus, what we are teaching, and restructuring the whole thing. It is possible to introduce something like this new subject, the syllabus, the content into the syllabus. So let us talk about those things, what were traditional for me. Hope audio is clear to all of you. So we are,
Yes, sir.
yeah, okay, fine. Hitherto, we are talking about the financial statement analysis in the form of basically financial ratios, cash flow statements, funds flow statements, common size balance sheet analysis, trend line analysis. All these were used to reflect their performance, to measure their performance, to measure the efficiency of these organizations. But what we are doing, we are just, for example, financial ratios may be based on the profitability ratios or operating ratios or efficiency ratios or turnover ratios or liquidity ratio. All these things we are doing. And we used to measure with a standard. But we never used to compare or use those ratios for the well-being of the company. We never used to say this is a good ratio in which based on this ratio we can advise the investors to invest in the company. We are not doing that. We're just confining the standard ratio is 2:1, current ratio is 1.8, so company is not performing. Our current ratio is 2.5, standard ratio is 2:1, so it is fine. These are all the things we are just confining. But now there is a drastic change in the measurement tools. So therefore, we should be in a position to analyze out of the boundaries of all these financial ratios, maybe return on capital employed, return on investment, or return on assets, or something like this. So a step ahead of all these things is known as economic value added or market value and market value added. These are two different perspectives, different dimensions we have to measure. So why this economic value added and what is this market value added is the subject which I opted for a discussion today. There is a lecture which I'm going to deliver. So based on that, you can develop. Many of you may be pursuing research or inclining to do research in the near future. So are interested in teaching finance. For all those people, this is very, very useful, and it will be a new area for the research. A lot of work is being carried out in the corporate sector. So you can add, rather infuse this into your own interest. So that is the need for today's subject. As I said, financial performance, we used to measure through financial ratios. Most of the times, especially for college teaching, we used to talk about financial reports with the help of financial ratios. And this was measured, used rather calculated only to determine the health of the company. And sometimes we used to use that to measure the effectiveness of these companies. Effectiveness in the sense, the ability of the company, the efficiency of the company, how best they are using their resources. Because the financial resources, especially, they are scarce in nature, as you know very well, and also they are having alternative uses. So when they have alternative uses, definitely we should make use of them to the best possible extent. So that is one of the fundamental and the core definition of economics. So the optimal utilization of scarce resources which are having alternative uses. So again, finance is scarce in nature, availability of funds are limited in nature, and those funds are also having alternative uses for which we have been studying and teaching ever since you started your career. So how to make use of these resources, how best we should be in a position to evaluate the viability and the feasibility of optimal utilization of this scarce resource rather, which is having optimal utility, optimal utilization. So that is the fundamental question. For that reason, in finance, of course, we use certain techniques like evaluating techniques, like capital budgeting techniques, and there's a different dimension. We calculate that based on the net present value techniques or internal rate of return. All these things we have crossed, and we use them as tools for evaluating capital investment projects or investment projects, or investment decisions are taken based on those things. So companies' effort in using the whole financial resources effectively and efficiently is to be calculated, or rather in order to achieve the maximum utility or the goals, or rather to maximize the wealth of the shareholders or the wealth of the firm, or to protect the interest of the investors or the stakeholders at last, or rather at least, we have to calculate all these things. So, but those things were confined for making decisions. Yes, this project is viable. This project is feasible. This is having a positive NPV. This is generating so much of return. So based on those things, we are so comfortable in taking the decisions, especially in the classrooms. But it comes to the real life, it may not be so. So, for instance, a Reliance company, when the Reliance is investing in a telecom sector, so they can't straight away take a positive NPV or negative NPV and evaluate. The investors can't say, oh, this project of Reliance had a positive NPV, let me invest. No, we were not authoritatively employing those techniques, or rather those tools, for our own benefits. As an investor, I can't take a decision based on the NPV alone. As you know very well, NPV is a futuristic approach based on the projected cash flows of the near future. We were determining the viability and the feasibility of those projects, assuming that the project is capable of generating so much of revenue, cash flows, much before the interest, much before the taxes, much before the depreciation. All these criteria is a stereotype mechanism of determining the cash flows, and based on that to evaluate the authenticity of those cash flows. At the most, we scientifically employed the probabilistic cash flows. What are the probability of getting this much of cash flow in the year 1, year 2? All those things we calculated. Yet they suffered from severe limitations, several limitations, like, what is the accuracy of the assumed cost of capital. I'm emphatically using the word assumed cost of capital. So if the decisions which were made based on this assumed capital, which was not realistic, which was uncertain, so definitely the decisions are also as vague as the assumption of the cost of capital. I hope you're following. So the decisions which are based on this assumed cost of capital were not sure. So whatever may be the approaches, probabilistic approaches we use, one factor was the denominating factor, the assuming factor was the discounting rate or the cost of capital or whatever it is, which was not realistic. That was the greatest limitation of those techniques. So therefore, we have to overcome those things, and the limitation itself is the cost of capital, as I said, which was not possible or feasible for us to assume the rate at which we are to discount the cash flows. To overcome all these things, this is a mechanism, this is a tool, this is something which helps us to evaluate the viability, feasibility, authenticity of determining or rather protecting the investors in the form of knowing their own earnings per share, or return on investment, or return on capital employed, or return on equity, whatever it is. So therefore, economic value added is a practical method of estimating the economic profits against the accounting profits. So there is a clear demarcation, you should know that, between the economic profit and the accounting profit. So as you were familiar with finalizing the books of accounts and preparing the trading and profit and loss account and calculating those profits are entirely different, and arriving at the economic profit, measuring the decisions, evaluating the decision is entirely different. Therefore, we should be extremely careful in evaluating these. So that is the reason, rather EVA is one such explanation, one such phenomena, one such concept or dimension which facilitate the investors to evaluate their own investment. So firms always focus on maximizing the returns. One of the fundamental core objective of the finance or financial management is to maximize the wealth of the investors, maximize the revenues of the firm, maximize the profits, maximize the welfare of the individuals who are part and parcel of this company. So if the employees are having good frame of mind, good well-being, or rather they have a very good morale, which makes them to work for the organization. That is the healthy state of mind, which makes them, or rather stimulates them to contribute something for the betterment of the organization. That betterment results in volume of sales and perfection of the products what they're producing, in turn results in the revenue or the profits. So all these things were happening. Now we are just gone one step ahead of calculating the income, the profit or the revenue, whatever it is, apart from the net profit, is there any residual income the company is capable of earning, or rather not just capable, is earning or rather earned in the last year. So that residual income acts something for the betterment of the company, acts something for the decision making of the investors. And that residual income approach, what we are dealing today, is termed as the economic value added. I'm just giving the general introduction of that. I'm not defining yet. So that residual income, we are going to measure how to calculate the residual income of the company after meeting all expenses. Remember, hitherto what we teach our students right from PUC, first PUC, accounting till MCom, BCom or MCom, we never come across residual income. So we just follow the prototype measurement of the gross income, gross profit, net income, net profit, operating income, operating profit. We move in those directions. But residual income, we kept outside the purview of our own analysis of financial statement. But now, in this present scenario, that residual income helps us to measure the volume of income the company is capable of earning over and above its normal return. So that is the beauty of this concept. So that is what we are going to study in detail in this session. I hope you are following. Okay, so financial statements are evaluated, as I said, using financial ratios. So in financial ratios, we used to categorize those financial ratios based on the fundamental aspects, like those which are measuring the efficiency, those were rather turnover ratios, or measuring the profitability of the firm, or measuring the solvency of the firm, or other financial ratios, or which is capable of meeting their operating costs and operating expenses or financial break-even. This is what we were dealing earlier. But now there is a dire need for us, our financial analysts, our financial evaluators, to think beyond those norms. So therefore, there are numerous ways which are available at present that investors and lenders, they want to estimate the value of the company. So they use different yardstick. It is not just the asset test ratio, which was essential earlier days to measure the financial performance, liquidity status of the company. So this is an increasing aspect in the modern corporate global scenario. So the companies are exercising themselves in a different dimension, claiming that they are having edge over other competitive firms. So they are differently capable of, they are capable of generating more revenue, or rather that more revenue is residual income, which is sufficient enough for them to meet the future requirement also. So in the earlier scenario, we are saying just computing 2:1, 1.1, something like that. So therefore, this exercise helps us to understand what is the cost of the company. in other words, what we talk about the cost of capital. So apart from the cost of capital, in those companies, earlier traditional analysis, we used to compute the cost of capital, the weighted average cost of capital, cost of equity, cost of debt, all those put together, whatever we have in the capital structure, maybe the pillar, that is equity share, preference shares, reserves and surplus, long-term borrowing, short-term borrowing, all those things used to form the structure of the company. That structure is mobilized, rather the component, each component of the structure is mobilized at a specific cost. And those specific costs are computed together based on their weights, and we used to measure the weighted average cost of capital. So that weighted average cost of capital is considered to be the minimum expenditure the company should meet, rather earn out of their revenues. So if the revenue is matching that, financially they're just equating the requirement. If the revenue is exceeding that, they are in a better position. If the revenue is not sufficient enough to meet at least the break-even point, the cash break-even point, or the financial break-even point, or the weighted average cost of capital, and we used to tag that the company is underperforming. So these are all things which we are using to evaluate. But in the modern scenario, as we are talking today, we'll be more focusing on this economic value added, or economic value addition, what the company is creating. So that is the fundamental issue which we are dealing in today's session. So EVA, that is economic value added. So as of all of you know, economic, the term economic itself sounds something great, something huge, something vast. So you define any business, any activity. So we talk about the economic activity. So business, it's fundamentally, business itself is an economic activity. So what is this economic activity? As you know very well in the preliminary definition itself, it is the earning and spending activity. So that earning and spending activity so far used to derive the revenues and subtract the costs out of that, and the difference between the revenue and the cost used to term it as the profit. Whether that profit is sufficient or insufficient or more than something, we are not bothered about those lines. So economic value addition is a concept, is a practical method, rather, instead of a concept, rather more than a concept, is a practical method of estimating the economic profit that is earned as against the accounting profit. So economic profit is much more superior than the accounting profit. So as all of you have discussed in the classes, when you are teaching financial accounting ratios or something like that, we used to measure the performance of the companies with the help of the ratios. Suppose the company's ratio is something more than the normal. So based on the book values, based on the trading account, based on the profit and loss account, or the financial statement, they used to compute. So all of you must have been in a position to analyze, if a company is earning huge profit in the books of accounts, if it is shown in the balance sheet, or rather it is distributed, maybe in the reserves or profit and loss account, balance, whatever it is, may not be in a position to meet its day-to-day requirement in terms of liquidity. These are what the limitations which you explain to your students when you're teaching ratio analysis. So ratios are computed, no doubt about it. They are based on the past performance. It is a history. When it is a history, it is a dead past. So we can't think of the same thing in the near future. So there is no guarantee that whether companies are capable of earning or generating the same revenues in the coming years also. But accounting profit normally, in most of the cases, if not in all the cases, tries to mislead. The figures which are reflected in the books of account may not be same with the liquidity position. Earning 10 crore rupees as a profit, whereas the cash position or the liquidity position may not be even few 100,000. But as per the records, profit is very huge. On the contrary, some companies continuously incurring severe financial losses. They are facing financial crunch in the books of accounts. Financial losses, net loss, they are showing incurring net loss as per their books of accounts. But continuously, though they are incurring losses, they are financially sound. They're capable of meeting all those expenditure. Their bank balance, the reserves and the funds, everything is in a good position. But in records, on the papers, they are showing financial loss, net loss. So this is the contradicting aspect of the tool which was using. There is a high degree of inconsistency in these tools, financial ratios. So when there is a high degree of inconsistency, obviously they are misleading. They're misleading the general public. They're misleading the government. They're misleading the stakeholders. Primarily, they are misleading the investors. So therefore, to know the healthy financial health or the healthy state of affairs of the firms or corporates, we should use some yardstick, which is very, very essential, which must be a realistic one, highly consistent one, and reasonably fair. Yes, we can believe. So such a tool is economic value added. That is why it is a practical method of estimating the economic profit that is earned as against the accounting profit. So accounting profit is different and economic profit is different. So we can just link something like this. Most of you must have taught cost reconciliation statement. So in the cost reconciliation statement also, used to ascertain there is a difference in the cost accounting profit and the financial accounting profit. So you used a lot of techniques, or rather used your knowledge, information, adjustments, what we call, to make good the differences in any of the books of accounts. So either used to reach the profits of the financial accounts or used to arrive at the profits of the cost accounting by preparing a reconciliation statements, undervaluation, overvaluation, all these things you know very well. So here, similarly, the accounting profits are different and economic profits are different. So they are misleading, they are contradicting as well. So we can, after studying this, you can come to a conclusion that accounting profits are always misleading if they are not disclosing or revealing economic profits. So that is the ultimate conclusion we arrive after understanding this concept. So therefore, why we are not learning this, why we are not teaching this, rather why we are not using this as a tool or a mechanism to evaluate the performance of the organizations or corporates. That is why we are studying this. Economic value addition is established a superior method of performance measurement tool. It is a superior method of measuring the performance. It is also an incentive compensation system compared to traditional methods. So there is a lot of inconsistencies in the traditional methods. So therefore, it is a right time and that there is a dire need for us to understand this concept and project the performance of the companies in terms of their economic status, in terms of their economic profits. Further, economic value addition, it is a strategy formulation to measure the financial performance. So there is certain strategies we have to evolve, the tools we have to use this to measure the financial performance. And then only if economic value addition acts as a tool to take better investment decisions. Most of the companies, they reveal their originality. It's an exercise, it's a mechanism through which they understood their own strength, through which they understood their own limitation, their own lacuna, their own financial deficiency. When such a tool is available, definitely it's always advisable to have that in the real life application. So that is one aspect. So it is also an ability of an organization, rather this tool acts as an ability to, rather an ability or an opportunity for the firms to measure their own economic efficiency. And it is also a managerial performance tool. So apart from your investment revenue cost, you are also capable of measuring your own managerial performance. More often, we don't give much importance for managerial performance. In general performance, we speak, but financial performance, we measure all this. So even after measuring the financial efficiency, financial performance, when we are lacking means, definitely there is a need for us to understand this tool, how it is different from others. So that is the intent behind this subject. So performance measurement tools. As teachers, we know very well, we have our own yardstick to measure on our own performance. As a teacher, we have our own tools and techniques to evaluate our own performance or the students' performance, something like that. So similarly, there are many techniques which are universally accepted, adopted, but these companies are not accepting them as a real tool for measuring their own efficiency. That is also one of the reasons for not adopting these techniques so far. Though it was introduced long back, early 90s, it was introduced, it was not very much adopted voluntarily by these companies, or not, rather not mandated as well. But these days, this requires a lot of importance. It acquired a lot of importance in most of the corporate world. So economic value addition in general connotation, what is the value that we are creating, rather what is the value addition what we are creating, which results in the financial status or wealthiness of the company in terms of economic profits. So as all of you know very well, it is economic input is converted into output. We are transforming the inputs into outputs. So we are creating some value for the raw material. So raw material is input. We are converting, adding labor and other things. So we are converting that into finished products. Through the process, your raw materials are acquiring some values. So similarly, your input in any form of business, any type of organization, any sector or any manufacturing or service or any organization for that matter, or a company for that matter, your input here is your capital. Only capital, financial resources. So you're using financial resources. What is the value addition you are creating for your financial input, financial resources, and what is the value of those financial resources at the end of a specific period, or at the end of a quarter or annual, at the end of a year or something like that. So that measurement tool, that measurement is known as economic value addition, not just in terms of net profit, not in terms of gross profit. So we invested some money, so we wanted this much, so we recovered that. Even after recovering, we are left with some residual income. That residual income is your economic value addition, or the economic value added for your capital employed or for your business or concern. It's a very simple concept. In the second session, we let us try to solve simple problems, and you will be in a position to understand that in a better manner. So hope you're all following. So next, how to gather or rather calculate this economic value addition how it is possible for us to understand the concept of economic value addition we understood theoretically, how to gather that information. So therefore, there are 5 main steps are there in computing or calculating the economic value addition. The first and the foremost one is the review of the financial data of the company. We need the financial data of the company. So that is the fundamental aspect. The first and the foremost aspect is gathering the financial data. Without the financial data, we just can't do anything. We can't evaluate anything. So whatever may be the published data they have, fine. With that, we can compare whether they're reflected in the manner in which they are supposed to be reflected, or whether they calculated, computed the normal or fair means and fair measures, whether they are computed or presented appropriately. So therefore, we need the financial data. So most of the companies, they publish their annual reports. So with the published annual itself, we are definitely in a position to calculate. Remember, it is only a calculation. When we are calculating, the assembling aspect of the information in the sense, the data, that is the revenue aspect, the cost component, the cost breakups, the financial costs and the production cost, of whatever the operating cost. So we interchange that in a different dimension, different stages, and we ascertain different values. So that would be the real value which they are lacking in representation or presentation of their annual reports. So the needed information should be there. All the information, once we have, we can review the ability of the firm, financial ability of the firm, financial strength of the firm. So therefore, the first step is gathering the required financial data. So without the financial data, it's impossible to think of any EVA or NVA of the company. The second step is very simple and a very important step also, calculation of company's net operating profit. This is the core aspect of the entire EVA, net operating profit, calculation of net operating profit. What is this net operating profit? Normally, in terms of EVA, in the lines of EVA, in the balance of EVA, we call it as NOPAT, N-O-P-A-T, net operating profit after taxes. This is a very important thing. Based on this only, it is possible for us to calculate EVA. So therefore, the second and the foremost important step is calculating the company's net operating profit after taxes. It is a measurement. It is a stage or the step which measures the company's cash generation capability. We will be measuring the company's cash generating capability. So therefore, this is a very, very important stage. As you know very well, the limitations of financial statements, limitations of financial statement with respect to cash expenditure and non-cash expenditure. All of you are well versed with that. For instance, depreciation. So depreciation is a non-cash expenditure, but it's a part of cost. So normally what happens while computing the cash flows of the business, so after ascertaining the earnings before depreciation, interest and taxes, that is revenue minus operating cost is EBITDA. So depreciation is a part of that. We subtract depreciation. So EBITDA minus of the depreciation, you will get EBIT. You just recollect the stage or the step what you follow. So from that EBIT, you subtract the cash expenditure for your borrowed capital. That is the cost of capital. That is also called financial expenditure towards your mobilized capital or borrowed capital or long-term capital or whatever it is. So therefore, That step is very, very important. And after deducting depreciation, you just deduct the interest. I hope you're all following, isn't it? So now I just cross-checking you. As I said, from EBITDA, we subtract depreciation. Only after subtracting depreciation, we pay the financial expenditure or the cost which we incur for the borrowed capital or mobilized capital, isn't it? What might be the reason for that? Anybody? I'm asking all of you. Anyone can answer.
Because for tax purpose, sir, I think interest is deductible, for computation tax, because the interest is adjusted for tax purpose.
Any other answer? Okay, fine, correct. Any other answer? I need an appropriate word for that. You are right. Answer is correct. We use one particular word for that reason. What kind of expenditure they are called? Anyone can try. I'm just asking out of curiosity. Nothing wrong. Answer is absolutely right. Nothing wrong in it. Anyone can try. Nobody? So it is called, as per your income tax, it is called what type of expenditure? They are called admissible expenditures. They're called admissible expenditures. So when we consider depreciation as a part and parcel of our operation, so therefore that should be deducted, so that is treated as an expenditure. So we need not pay the tax on that also. If it is not deducted, that remains there, and that cost is also part of it. Therefore, we deduct that from the normal earnings. Only after that we pay the tax, and interest, EBITDA, interest also we are paying. And then that interest on the borrowed capital is also an admissible expenditure. So therefore we just deduct all those things, and then we add back depreciation. We add back depreciation to ascertain.
Sorry, sir. Doubt I have.
Yeah.
So normally what the companies they will do, sir, and some companies I think they are going to adopt a straight line method of depreciation. Normally for tax purpose, actually return to own value, we are required to charge the depreciation as per WDV only. But I think some differences will arise, sir.
Yeah, any amount, whatever the method that they're insisting, admissible method they have to follow. Depreciation is finally considered as a non-cash expenditure. While evaluating the cash flows, they are misleading, because whatever the depreciation you subtract, whether straight line method or WDV or any amount which is not revealed is deducted, again we are adding back to ascertain the net cash flow. That is very important here. So we are taking the decision based on the cash flows. So actual cash flows only are important for computing this, what we're talking about, EVA. So depreciation is an expenditure, is an admissible expenditure, irrespective of the method that you are following. Sometimes overvaluation, undervaluation, you are based on the book value, based on the market value, and so many hidden aspects are there. That is a different dimension if I start talking about that. So therefore, I don't say mismatch. There certainly there will be mismatch with their actual depreciation and the claiming depreciation and projected depreciation. But whatever they show it here, my point is, whatever they deduct from their EBIT, they are going to add it back. That is very important. So the cash flows, they are remaining with the firm itself. The depreciation is a non-cash expenditure. Therefore, to know the actual cash, we add it back. Hope Ravikant is clear to you. Okay. So therefore, we subtract that and we arrive at the net cash flows. So based on these net cash flows, again, we are going to take the decision. Here, interest, what we are paying. Next aspect is interest, what we are deducting. So that is the weighted average cost of capital. That is based on all the structures, what you are raising, equity, debt, or borrowed capital, long term. So you have a specific cost and the weighted average cost of capital you compute and you deduct that. So based on that, you will be in a position to arrive at the net present value. You subtract your cash outlay also after converting that based on this rate. So here remember, I said earlier, the NPV is an assumed rate, whereas here the interest what you are paying, remember, your interest which you're deducting is the actual cost for your borrowed capital. So that may not be similar with the assumed rate. So that is also one of the limitations you are coming across when you are evaluating such investment decisions thoroughly. So when you are taking, remember, you have a structure in the capital, maybe 50 lakhs, 10 lakhs, 40 lakhs, which you are raised, for which you have specific cost. You also ascertain the specific cost. What is the interest you are paying on your debenture or long-term debt, or what is the expectation of the shareholders, how much you have to pay. That is some cost involved. And assumed rate is different, 8%, 10%. So calculate NPV based on the 10% discounting factor. And you're all familiar with the present value factor itself, and we straight away multiply that and get the value, something like that. So that is the difference, what we are trying to understand here. So there may be a chances of differences between the rate at which we are discounting the cash flows and the rate, or rather the financial expenditure that we are incurring or meeting for our borrowed capital. So that is what we are about to calculate, the net operating profit, that is NOPAT, net operating profit after taxes. That is a very, very important component. We have to trace that from the obtained financial data of the companies. So that is the second step. The first step is gathering the data. The second step is calculating the company's net operating profit after taxes. That is NOPAT, N-O-P-A-T, net operating profit after taxes. Third step is calculating the invested capital of the company or the capital employed of the company.
Sir, one question I have, sir.
Yeah.
For discounting the cash flows, okay,
Yeah.
sir. Normally, you told me that, we are going to consider the assumed
Cost of capital.
Capital.
Assumed rate.
Now the question is there is any slight difference between the actual cost and assumed cost?
There are not slight. There may be difference, maybe 10%, 5%, 2%. Definitely there will be difference between the assumed rate and the actual rate. So that is one of the reasons for using this tool for evaluating the firm's ability to generate cash flows, ability to add the values for the market value of the firm or the economic value in terms that enhances the cash flows of the firm. So definitely there is a difference between the assumed cash and the assumed cost of capital and the actual cash which you are paying for our borrowed capital. Is it clear?
Sir. Yes, sir.
Sir, this is Gautam from. Sir, I have one query. So as the sir told that, but sometimes it happens. So in order to calculate NPV, IRR, we generally assume that is cost of capital. So my question is that by applying EBA, can you get the picture of exact discount rate or the exact that is the present status of the market?
Yeah, that is why we are going to study this tool. At the end of the session, definitely we'll be in a position to know what is the cost we are incurring. weighted
Okay.
average cost of capital, we know what is the equity we have borrowed, what is the debt we have borrowed, what is the specific rate at which we are meeting all these things, what is the obligation, what is the financial obligation that we have for these borrowings. So this is the rate we get, and the amount also you will get. Say, for example, your weighted average cost of capital is 10%, assuming that. So 1 lakh is your overall cost of capital, overall structure. In the structure, you have 1 lakh, 10% is your borrowed capital. 10% of 1 lakh is 10,000. So
Yeah.
10,000, which is the actual cost we are meeting.
Yeah.
So while teaching our students, what we say, you discount the cash flow by cost of capital. Assume a cost of capital at 10%. Why should we assume when we have the real cash flow, when we have the real expenditure?
Right,
So
sir.
when you teach in the classroom, when you are enjoying your teaching there, at 10% a student will accept the project. At 15%, you ask them to reject the project.
Yeah.
Isn't it?
Yes.
So there is an inconsistency in our own decision. So 10%, anything below 10% is always positive NPV. Anything more than 15% is always negative NPV. So you make a lot of exercise for the student. You calculated 8%, 9%, 10%, and somewhere they arrive at some negative and some positive. So in between this positive and negative, your IRR lies.
Yeah. Yes, sir.
You also teach that. When you teach IRR, so NPV at the lowest trial rate, you take that divided by the difference between or the delta of the gross present value of the lower trial rate and the highest trial rate, you multiply with the delta rate what you teach. So therefore, we find, because we will not be knowing what is the rate at which we are discounting. So you assume, we say, hypothetically we say, if the cost of capital is 10%, is it possible? Why we again say, remember, why we say that assume a cost of capital? Because it is a projected cash flow. It is also a projected investment. We don't know, we don't have money to invest.
Yeah.
So if we are capable of investing at this rate, is it possible to arrive at a positive NPV? Is it possible for us to arrive at a negative NPV? Can we take a decision? We can accept the project or reject the project based on that, because everything is projected there. So rate is also projected, assuming that we are capable of getting that capital at that rate, then the positive, it may be positive.
Yeah.
And again, they're all projected cash flows. So only after the investment, it might be possible for us to generate. Again, a degree of uncertainty is there. Whereas here, we have already invested. We already started. So we have the actual data. What is the revenue we generated? We have. What is the interest we paid? We have. What is the cost incurred? We have everything. So officially we have, authoritatively we have. So we have to reveal and use those things, use those metrics to determine or evaluate the viability of our capacity or the earnings capacity of the firm or extra earning capacity of the firm.
Okay, sir.
That is the line of demarcation between these two aspects. I'm not saying outrightly reject NPV. I'm not saying outrightly you reject IRR technique. No, definitely not. So it is an extension. So, okay, we assume there, with the assumption we started, we evaluated. So between positive and negative, we arrived at some rate which is much superior than NPV. NPV suffered some limitations, like it is having assumed rate. And always when you have a lower discounting rate, definitely will have always positive NPV. When you have higher discounting rate, always you will have negative NPV. So when you come across yeah, please.
Sir, we can say that EBA deals with the present situation. Means once the investment is done,
only after the investment is made, only after the commencement of the business.
In fact, like if we just consider the capital budgeting, just before making an investment, we are assuming it just deals with the future, right, sir?
Yeah. Okay. See, remember, financial statement analysis can be made only after the commencement of the business, only after earning the revenue. So based on the past performance or last year performance, we can compute the ratios. Maybe liquidity, solvency. So similarly, to overcome those limitations which are existing with these financial ratios, we are trying to emphasize on something like EVA. So this is the post-mortem analysis, whether that NPV technique is much before the commencement, much before the investment. We need this much, we might require this much. We may be in a position to mobilize the capital at this rate. We are assuming that. We assume that. So that is the post scenario, and this is the pre-scenario of the business.
Thank you.
Okay.
Thank you, sir. Thank you so
Okay.
much.
So the third step is calculating the invested capital, how much we have invested, how we invested, what are the sources in which we have borrowed, whether we have internal sources or external sources. So all those things can be computed. The invested amount is an important step in finding out the economic profit. So what is the actual interest we are paying, actual dividends we are paying, what are the expectation, what are the interest on debentures we are paying. All those things are also essential. So that is a parameter, it is a metric to measure the efficiency also. Therefore, the third thing, we have to ascertain exactly what is the capital that we employed for this business. And the fourth step is, after ascertaining the capital, the fourth step is computing the weighted average cost of capital. As you know very well, cost of capital plays a predominant role in evaluating the investment decisions. So we have borrowed the required capital, what we talk about in the capital budgeting stage. We raised it through various sources at different rate and different specifications we have. So we compute that. Some of them are exempted from taxes, some of them are not exempted from tax. So if you have more debt, that is also an important thing. So if you are having more borrowed debt, it is something for a company. If you have less borrowed debt, it is something for the company. Any debt we actually are borrowing from outside, any interest which you are paying for that is exempted from tax. That's what I said earlier. It is an admissible expenditure. So therefore, at the time of computing the cost of debt, straight away we write the interest divided by the debt multiplied by 1 minus tax rate. So whatever the tax which is prevailing, or rather you are paying, that much is exempted for that. Suppose your rate is 30%, so 1 minus 30%, 1 minus 0.3, 70%. To that extent only you are liable. So while computing the tax, you use a tax on your, interest on your debt, you multiply by 1 minus tax rate. So using all those variables, components, you will be in a position to ascertain your weighted average cost of capital. So that is the fourth step. I'm sure all of you are familiar with that concept of computing the weighted average cost of capital. Weighted average cost of capital might be consists of cost of equity, cost of debt, cost of preference shares, cost of retained earning, and all these things are very fundamental extension. So cost of equity. Cost of equity is the expectation of the shareholders. So expectations of shareholders is not constant. Again, it will be changing, it will be varying. It is ranging from one rate to another rate, fluctuating because of the expectations of the shareholders. So shareholders are not happy. 10% today you are giving 10%. So next year they want something more. So therefore, we use a different model to compute the cost of equity. Normally, what model we use to compute the cost of equity? What is the model we use? So we use dividend growth model. Dividend growth model to compute the cost of equity. So whatever the expectations of the shareholders at the end of the year one, so dividend expected at the end of the year one for the investment that they made at the 0 year. So D1 by P0 into on growth rate, whatever that 1 plus growth rate. So dividend growth model we use. So like that, all components should be calculated. So if you have 2-3 debts, different rates, remember, this is an important concept again. So if you have a lot of debts, you can't club that debt again, though the debt is 50%, you have to segregate that debt in different parts, 30, 20 or 50, whatever the ratio in which they are, the rate at which they are borrowed, you compute that, you will be in a position to calculate the cost of the borrowed debt, the weighted average cost of debt, weighted average cost of debt. So you have the cost of equity, you have the weighted average cost of debt, plus the weighted, plus the weight of cost of preference shares or the retained earnings. All these things put together, weight of equity into weight cost of equity, plus weight of debt into cost of debt, plus weight of retained earnings into cost of retained earning. All these things put together, the weighted average cost of capital. Right? And that is the fourth step in this stage. I hope you're all following. So
when you borrow the funds at different rates,
yeah.
So for computation of WACC,
Yeah.
That average interest rate is to be considered, or
No,
actually
weighted interest rate. Suppose you are in the debt, there are three types of debts. One is at 8%, one is at 10%, and one is at 3%, 12%, something like this. So you take the entire debt, maybe 50 lakhs. So out of 50 lakhs, 25%, 25 lakh is at 10%. Then you should take 25 by 50, that is 50% of that debt multiplied by 10%. The remaining at different rate, again 12 lakhs, whatever it is, 12 lakhs divided by 50 lakhs into the rate. And the balance 13 lakhs divided by 50 lakhs into the respective rate. So when you club that, you will get the weighted average cost of debt, not the weighted average cost of capital.
individual cost of debt, but the weighted average cost of debt.
Weighted average cost of debt. So that will be clubbed again for the weight of equity into cost of equity plus weight of debt into cost of debt. Here we have to take the whole debt in the sense 50%, whatever the amount. So respective debt must be multiplied by the respective rate at which you mobilize. For example, D1, D2, D3, debt 1, debt 2, debt 3. So that should be taken as a numerator against the denominator of the whole debt, not the whole capital. Whereas the whole debt, when you are computing, the total capital of the firm is taken in the denominator. We will deal that in the next session when we are working out a problem. That is not a problem. So weighted average cost of debt means not just weighted average cost of capital. So you have to segregate. We are borrowing from different rate, different sources. So that should be clubbed and arrive at the weighted average cost of debt. So that is the fourth step. And the fifth step is
sir, one question, sir.
Yeah.
The calculation of weighted average capital is consider the price level changes, sir.
Price level changes, yeah. At the time of inflation accounting, we can consider that also. Price accounting for price level changes. You mean to say that inflation accounting? Are you sure? Hope you're following. It can be considered for accounting for price level changes. Can you hear me?
Yes, sir.
No. So therefore, the fifth step is computing the economic value added. Is the final stage. Fifth stage, you arrive at that. So weighted after ascertaining undergoing all these things, you will in one line you get the answer or the value. That is economic value added basically represent the firm's profit after considering the cost of capital. Remember, it is a tool which considers the capital, cost of capital, and what is the profit the company is capable of earning. What is the potentiality of the company after meeting all its financial requirements, after considering all its cost of capital. So that is the important aspect. So then the last step you get, it is the financial performance measurement to capture the true economic profits of the firm. Okay, so therefore economic value added equals NOPAT, what I said earlier, net operating profit after taxes, net operating profit. So we should be in a position to compute the net operating profit first. So from that, if you subtract the weighted average cost of capital multiplied by the whatever the investment. Suppose your weighted average cost of capital is 10%. the capital is 1 lakh. So 1 lakh, 10% of 1 lakh is to be considered 10,000. Whereas your NOPAT, net operating profit after taxes, is 20,000. So minus this 10,000. So your economic value added is 10,000. So like this, it is very simple. The fifth step, you have to have net operating profit after taxes. Subtract that what is the interest financial expenditure that you are incurring for your borrowed capital. You subtract that. The difference, the excess, the residual income what you have, that is considered as the economic value added for your firm or the business. Very simple concept. So when you numerically work out this, it will be very easy. So now, why should we do all these? What are the advantages of having EVA, something like this? We have to debate. So no doubt, traditionally you used to measure the ratios, and based on the financial ratios, the financial performance is to be evaluated. After knowing the limitations, there is no meaning in continuing in those limited ratios. So we have ratios, as I said earlier, your ratios are sound, your ratios are good, but your liquidity is worse. You have the profits in the papers, in the books of accounts, your reflected profits, but incurring financial crunch. So they are all known, established limitations. So to overcome those limitations, we have EVA, economic value added. That is a better measure. So the advantages of this, it enables us for a better decision. It helps us to take a better investment decision. So as an investor, I want to know whether the company is capable of generating something more than its requirement. See, as you know, individual financial strategies, you have your own income, you know very well, you know your own expenditure. So at the end of the month, definitely you're in a position to say what is the surplus that you have in a month. Whether you are meeting all your requirements in a month, in that particular month, do you have any surplus? So it's easy for you to know whether you're having a deficit budget in that month or surplus budget in that month. So when you have some money which is left over, after meeting all expenses, that is fine. That means you are capable of generating or earning much more than what is required for you. In terms, you call that as, in turn, you call that as savings, isn't it? So so far, you have not used the term called savings for a company. An individual, when we are taking a decision or when you are having our own salary, our own expenditure, normally what we say, oh, this is my monthly income, this is my monthly expenditure, minimum expenditure, and this is the maximum expenditure. Even after meeting all those things, I left out this, left with this much. So that is my saving of the month, you say like that. So companies, they never ever come across something like this. They were reflecting everything, net profit or whatever it is, and profit they used to appropriate, P&L appropriation they used to do. So they used to transfer without knowing their efficiency. So this enables us to know how much we are capable of earning much more than the requirement, much more than the industrial norm, much more than the standard. So based on that, yes, this company is capable of earning more than its requirement, more than industrial norm, more than the established norm. So fine, I'll invest in this company because I want to safeguard my own interest. I want to earn more and more revenues. I want to earn as early as possible. I want to withdraw as early as possible. So understanding our own requirements, our own yardstick, our own parameters, we will be in a better position to take the decision. So that is possible only when you have EVA at your end. So that is the first advantage. Second advantage, it covers all aspects of business life cycle. So during a particular year, you have this EVA, next year you have this much. So in the last 5 years, what was your addition? what was your deletion, what was your surplus, whether you are simply showing profits without any value addition, or whether you are simply incurring losses with lot of value addition. All these things are not at all revealed in any of our financial statements. So you must remember one thing. When you are dealing with the cash flow statements or funds flow statements, after teaching ratio analysis is fine. These are the ratios. They're doing extremely well. All these things are same. When you go to cash flow statement, after teaching funds flow statement, so you will explain our own students. See, our cash is more realistic because all funds are not cash, but all cash are funds. So we rely more on cash. So cash is the tool which measures our ability. What they use a lot of funds without cash. We teach about all these things. You also teach something like this. So this funds flow statement, they dig out funds flow and cash flow statement. They dig out lot of things, lot of hidden things. No doubt